today. We're going to be talking about Apple, yep, the iPhone folks, and how they are playing the cards for 2025. So this is going to be quick. I've got 6 slides to walk you through. So let's jump in. So first up, huge news. So tariff exemptions, which have just been announced on Friday, a big win for Apple. So smartphones and electronics just got a pass on US tariffs. For Apple, this is massive since iPhones are their cash cow. So no tariffs means no extra cost creeping into your iPhone price tag. Now Apple's been eyeing this huge $500 billion investment plan in the US that they announced this year. Think factories, tech hubs, all their manufacturing onshoring back in the US to curb the tariffs announced by this Trump administration. But with tariffs off the table now, they're probably breathing a sigh of relief. It means they might not need to go all in on new facilities and could scale back or redirect some of that cash back to shareholders. And it's going to be a smart move if you do that, right? So let me take you through Apple's history just to give you a little bit of background about Apple's shareholder love story. Okay, so let's talk money, specifically how Apple's been showering its shareholders. So picture this. If you drop 22 on Apple's stock back at its IPO in 1980 and kept the dividends rolling, that would be worth over $52,000 today. Wild, right? That's a 239,000 plus percentage return. One share from back then is 224 shares now, thanks to stock splits since 2012. Apple's handed out $958 billion. Yep, that's close to $1 trillion with a big T through buybacks and dividends. I think it's gonna get there, so that's how you keep investors smiling. Oh, and check out this chart. It shows just how crazy those returns have been. So sorting out that European tax drama, as we know. Now let's get into a bit of a plot twist. Apple got hit with $15.8 billion bill from the EU, payable to Ireland over a tax dispute. But here's the deal. They're offsetting it with a $4.8 billion US tax credit and releasing 823 million reserve. That's because Apple historically has been paying a lower tax of 14% in Ireland. That is if you are paying a low tax outside US, then you get a tax credit and releasing an 823 million reserve. So the actual hit is around 10.2 billion and they've got it covered from an escrow account. So no dent in their free cash flows. Also their retained earnings took a dip, but don't panic. It's just accounting stuff from this. And all those shareholder payouts, not a sign they're in trouble, because this provisioning, the amount owing to tax was actually allocated some time back. So let's look at its capital expenditure. So Apple has been spending smart for the future. It's not just sitting on cash, they're spending it, but they're super picky about it. About 85 to 90% of their capital spending goes to growth, as we can see here. Think AI, hardware, chip production, and US facilities, while only a tiny bit, like 2.5%, is for keeping the lights on. That 500 billion plan we mentioned earlier, it's still in play, but with no tariff pressure, they might pump the brakes or shift some funds around. This chart, as we can see, breaks down where the money's going. Pretty cool to see how they balance it all. So let's zoom out and look at Apple's efficiency. Look at this, they're just killing it with $108.8 billion in free cash flows. That's money they can use to innovate or reward shareholders. Their free cash flow yield is a little lower at 3.11%. Not that very high though, but get this, their return on invested capital is solid at 44.31%. That means they're squeezing every dollar for maximum value. And look at their moat. That's basically how much profit they make per buck invested. It's 4.33. So each dollar invested actually produces around $4.33 in return. So one of the reasons for its high moat is actually its intangible assets, as we know, such as intellectual property and software licensing rights. So in short, Apple's running a tight, efficient ship. So let's move on to slide 6, which is going to be our last slide. So why do we think that Apple's still a long-term champion? All right, so let's stop and think. What's next for Apple? Their stock's looking solid with an intrinsic value of $247 per share based on its last 10 years free cash flows and future projections. And if they keep buying back their own shares, that could hit $416 in 10 years or earlier. Speaking of buybacks, they're shrinking their share count by 4.9% a year, which boosts their earnings per share and keeps the stock humming. So looking ahead, expect 5 to 7% revenue growth from AI services and their slick hardware ecosystem. Over the next 4 to 5 years, returns could be in 26 to 36% range. So not too bad, for a tech giant like Apple, right? So that's the Apple story in brief for 2024 and 2025. They're dodging tariffs, rewarding shareholders, handling tax drama like pros, and investing smart for the future, all while keeping that Apple shine. So what's the big takeaway? Apple is not just a tech company, it's a masterclass. It's more of a consumer company that the consumers can't live without, as we know. It's a masterclass in balancing innovation with discipline, whether it's navigating global challenges or it's doubling down on what makes them iconic. They're setting the stage for another decade of growth. So here's to Apple, is still dreaming big and delivering even bigger. So that's the end of this presentation. And if you have any questions, I'm all ears. I wrote about this, so you may check out our website, which is www.moodsinvestments.ca, or on our Substack account, so go check it out for the detailed version of my analysis. Make sure you drop your questions in the comment section. So take care and bye for now.